Hi, welcome back to Joe Blogs. In today's episode, I want to talk to you about what's happening in the Japanese economy, and specifically what's happening with the Japanese yen. Because over the course of the last few days, the Japanese authorities have actually stepped into the currency markets and started buying yen. And this is the first time that this has happened for more than 2 years. Now, interestingly, when you look at the history of Japan, in the 1940s, it was decimated by what happened in World War II. However, in the 1950s, the economy was entirely turned around and rebuilt, and Japan became a manufacturing powerhouse. And in the 60s, 70s, 80s, 90s, and noughties, it was the second largest economy in the world behind the USA. However, it lost that position in 2010 to China, and in 2023, it lost its position as the third largest economy to Germany. But it's still the fourth largest economy, so it's obviously a significant player. But what's happening right now is really concerning. Japan is a developed economy with a mature population that's been in decline for a number of years, and it's forecast to continue declining. And one of the problems that Japan has is that it's a net importer. So the cost of its imports are more than the value of its exports. So the value of the Japanese yen is really important to the economy, and as it falls in value, that means that the cost of all of those imports rises, and that puts pressure on everybody within the country. So in today's video, we'll talk about what's been happening with the Japanese yen. We'll have a look at the long-term trend. We'll then have a look at the interventions that have been made over the last few days and talk about the cost of that to the Bank of Japan, because they have been really expensive. We'll then talk about what's been going on with regards to inflation, interest rates, and the money supply in Japan over the last 5 years or so, and why the Japanese yen is under such pressure right now. And then finally today, I'll wrap up with my summary. So what I think the implications of the fall in the value of the yen and the interventions that the Bank of Japan are making will have on the Japanese economy. But before we get started on all of that, I'd like to say thank you so much to everyone that's supporting the channel. It really means a lot to me. If you bought me a coffee or sent me a YouTube super thanks recently, thank you for the time and effort you've taken to do that. Really appreciate every single one of those. I see all of your messages. They pop up on my phone, so I do read them. I don't get time to respond to every single one individually, so I'd rather say thank you in this forum. And also thank you to the long-term supporters of the channel. If you've signed up as a Patreon or a Buy Me a Coffee member or a YouTube member, thank you for that long-term support. Really helps to keep me going. It helps with the finances, obviously, but it also tells me that I'm doing something right, keeps me motivated, and keeps me posting more videos like this. So thank you for that support. As I mentioned at the start of today's video, over the last 15 years, Japan has fallen from being the second largest economy in the world to the fourth largest, and it's lost its place as the world's manufacturer. That position has been taken by China. And one of the other problems that Japan has is that it now has a declining population. As you can see from this chart, Japan's population peaked at 128 million in 2010. The population today is less than 123 million and is forecast to drop to 100 million over the next 30 years. And if we have a look at the population pyramid for Japan, which breaks down the population into 5-year age groups, you can see that the biggest single age range is 50 to 54, followed by 45 to 49, and then 70 to 74, and 75 to 79. So Japan has an aging population, and as you can see from the tapering at the bottom of this pyramid, the birth rate is continuing to fall, so less and less young people are entering the workforce, and more people are retiring. And that's going to put a heavy burden onto the state over the next 30 years. But the problems in Japan aren't just in the future, they're happening right now. And the issues in the economy are starting to manifest themselves in terms of the value of the Japanese yen. This chart shows the movement in the exchange rate between the US dollar and the Japanese yen over the last 5 years. And what this shows is that in May 2019, one US dollar was trading for around 110 Japanese yen. And in the period through to February 2022, the exchange rate remained relatively constant. And in February 22, one US dollar was trading for 115 yen. However, over the last 2 years, there has been a significant fall in the value of the yen. And today, one US dollar is trading for more than 155 yen. Which means that over the last couple of years, the value of the yen has fallen by around 35%, which is a huge fall for one of the world's largest currencies. And if we zoom in and have a look at what's been happening over the last 12 months, this time last year, $1 was trading for 134 yen, which means that over the last year, the yen has fallen in value by 14%. And if we look at what's been happening over the last month, at the start of April, $1 was trading for 151 yen. And as the chart shows, on the 29th of April, the exchange rate fell to 159 yen to $1, which represented a 5% fall in the month of April. However, immediately following this, you can see that there was a sharp correction as a result of the Bank of Japan's intervention, and we'll go on to talk about that in a moment. But even compared with the current rate of 155 yen to $1, we've seen a 2.5% fall in the value of the yen over the last month. And for a country that's a net importer, a sharp fall in the valuation of your currency is a major problem. This chart shows the movement in the exchange rate between the US dollar and the Japanese yen over the last 5 days. And the scale on the right hand side of this chart goes from around 154 yen at the bottom to around 160 yen at the top. And the brown dotted line across this chart is plotted at the 155 level. And the reason that is on there is that is seen by the markets as a trigger level for the Bank of Japan to take some action. The Bank of Japan does not want to see the value of the yen falling exponentially. And the market expectation is that every time the value drops below 155, the Bank of Japan thinks about making an intervention, stepping into the market and buying yen to support the value. So if we start off by looking at the exchange rate on Friday the 26th of April, which is shown on the left-hand side of this chart, you can see that at the close of business, the rate had crept up above that trigger level of 155 yen to $1. Now, over the course of the weekend, when the currency markets are officially closed, you can see that the value of the yen drifted further. And by the start of trading on Monday, the 29th of April, it had hit 159 yen to $1. And that was seen as being too high in terms of the Bank of Japan's opinion. And you can see that there was a sharp fall, almost a vertical drop in the exchange rate. And by the end of trading on the 29th of April, it was back down below 155 to $1. Now, sharp movements of this nature do not occur in normal markets. You see a gradual movement either up or down in price. The only time when you get a sharp vertical movement either up or down in the price of anything is when there's some sort of shock announcement or something untoward happens. Now, in terms of what happened on Monday the 29th of April, there was nothing in the market to justify a vertical movement in the price of the yen. There were no trade announcements, nothing came out that would have affected the valuation. So the only reason that the price of the yen moved so dramatically was because the Bank of Japan stepped in and bought a large quantity of yen. The Bank of Japan became a net buyer, and in any market when you've got a buyer of a particular item, it tends to drive the price up. So because the Bank of Japan was buying yen, it drove up the value of the yen, and therefore the exchange rate against the dollar moved in favour of the yen, and it came back down below 155. However, if we now look at what happened between the 29th of April and the 2nd of May, you can see that the value of the yen started to deteriorate again. And very quickly it went back up above that 155 level, the brown dotted line. And by the close of trading on Wednesday the 1st of May, it was up at around 158 yen to $1, which is obviously still above that critical 155 level. And as you can see on the 2nd of May, there was another sharp movement downwards in terms of the exchange rate. And once again, the Bank of Japan stepped into the market and started buying large quantities of yen. Now, as it stands at the moment, there has been no official announcement from the Bank of Japan. They don't actually release all of their data until the end of each month. So we won't know until the end of May exactly what the position was. But the estimate of the amount of yen that was bought on Monday the 29th of April is that the Bank of Japan spent $35 billion supporting the value of the yen. $35 billion in one day. If you put that into the context of what's happening in Ukraine, we've seen a recent package approved by the US government to support Ukraine, whereby they're handing over around $60 billion. Now, obviously, that is a huge amount of support, and that has taken a long time to get approval, and that's going to keep Ukraine going for a long period of time. So when you compare that $60 billion to 35 billion spent in one day supporting the value of the yen, which didn't last for more than a few hours. As you can see from this chart, the value of the yen started drifting again almost immediately after that purchase. It really puts into perspective what a huge amount of cash the Bank of Japan is throwing at this without having any real meaningful long-term impact. And this issue is highlighted on the far right-hand side of this chart, which shows that even after the intervention that took place on the 2nd of May, the price drifted back above 155 very quickly. And the reason for that is that the Bank of Japan is trying to distort the market. The market sets the price based on lots of different data. It works out what the value of the yen is against the dollar on a relative basis, comparing the economies, interest rates, inflation, growth prospects, and a lot of other economic data. So going in and buying yen to bring the price back to where you want it to doesn't fix that problem. It doesn't change all of those fundamental economic indicators. All it does is create short-term demand, which moves the price for a short period. But over the long term, the market will set the value. So what's going on in Japan to cause the value of the yen to deteriorate so significantly, and for the Bank of Japan to have to start spending billions and billions of dollars trying to support the value? Well, the problems in Japan have been going on for a long period of time. This isn't something that's happened overnight. And as I mentioned, there's a lot of different factors that feed into the exchange rate between two currencies. And the US dollar over the last 12 months or so has strengthened against most economies in the world. So a lot of currencies have seen their value falling against the US dollar. But in terms of the yen, it's fallen more than most economies because of what's happening in Japan right now. As I mentioned at the start of today's video, Japan is now a net importer and it's having to pay for fuel and lots of expensive things. And the price of a lot of those commodities is priced in US dollars. So the fall in the value of the yen does impact directly on Japanese consumers, and it also has a negative impact on the long-term prospects for Japan, because over the long term, the rising price of imports is going to deplete your foreign currency reserves. This chart shows the movement in the official rate of inflation in Japan over the last 12 months. And your first impression here might be that inflation looks pretty good in Japan. This time last year, it was running at 3.5%. Today, it's down to 2.7%. And those sort of numbers are the sort of figures that the USA, the UK, and a lot of economies around the world are trying to achieve. But the problems in Japan don't stem from high levels of inflation. In fact, it's quite the opposite. If we expand the scale of this chart out to show the position over the last 10 years, you can see that in two periods in the last 10 years, Japan has actually suffered from deflation, falling prices. In May 2014, inflation in Japan was 3.7%. However, by May 2015, it had fallen to 0.5%. And by May 2016, Japan was into deflation and prices were falling by 0.5%. And over the following 5.5 years through to the end of 2021, Japan struggled to get any inflation into the economy. And as we've discussed on previous videos talking about China, which is currently experiencing similar problems, the problem that you have is that when prices are falling, consumers tend to wait, because if prices are going down, why buy today when you can buy next week or the following month when it might be cheaper? And the problem with that is it tends to slow your economy down. And then as you have an aging population, they become more cautious. They want to save more rather than spending. And you can get into a vicious circle where the economy starts to contract. And also all of your companies within your economy are having to work in a falling price environment. And as we've talked about in previous videos, most companies work on the basis of having increasing costs, and to cover those increasing costs, you have increasing prices. But if you have increasing costs and falling prices, that means that your profit margins are being squeezed, and many companies can be forced into making losses. And this chart shows the movement in the official rate of interest in Japan over the last 10 years. And what this shows is that back in May 2014, interest rates were at 0%. However, as prices started to fall and Japan experienced deflation in 2016, the official rate of interest was actually reduced to minus 0.1%. So basically what that means is that if you put your money into the bank, it would lose value. You would actually be charged fees. And so the value of your capital would go down. Rather than earning interest, you would be charged money. So that really is a way of trying to encourage people to take their money out of the bank and spend more. It also makes loans very affordable, so companies and individuals were encouraged to take on more debt. However, the problem that Japan had is because of the aging population that we looked at earlier, everybody was very cautious, and so nobody really wanted to take on large amounts of debt, and so this stimulus really didn't work. And that's one of the reasons why Japan struggled to move away from deflation and to create some inflation in its economy. So if reducing interest rates isn't having the desired effect, it isn't resulting in an increase in inflation, the other option that you have as a national bank is what's called quantitative easing. So basically injecting large amounts of capital into the economy, making it easier for banks and financial institutions to be able to access that capital so that they can hand it out to consumers and businesses as loans, which then should stimulate more spending, stimulate growth, and increase both GDP and drive up prices. And that's exactly what the Bank of Japan has been doing over the last 10 years. It's injected huge amounts of capital. It's embarked on a prolonged period of quantitative easing to try to stimulate the economy. And at the end of 2022, Japan started to see the benefit of that and actually moved into positive inflation. It actually peaked above 4%. And interestingly, at that point, the Bank of Japan decided to change its interest rate from minus 0.1% to plus 0.1%, which obviously is still extremely low. But the key issue there was that it moved back into being in positive territory. And this was seen as being a major step forward for Japan, that it had moved away from having negative interest rates. However, if we look at what's happened over the course of the last 12 months, you can see that inflation has now started coming back down again. And when you look at this graph now, in the context of everything that we've discussed, it starts to look very different to when you first looked at it at the start of this video, when you thought, this actually looks pretty attractive, I'd like this for my country. What we are seeing here is a prolonged fall in the inflation rate in Japan, and that means that it's potentially going back towards being in negative territory. And that's the major concern from the Bank of Japan's point of view, that it doesn't want to go back to being in deflation. And unfortunately, it doesn't have a lot of levers left available to it because the money supply is already maxed out. Interest rates are at 0.1%, so the only other option that the Bank of Japan has is to move back into negative interest rate territory, which obviously didn't really work over the long term, so that isn't proven to be successful. So it's a real problem from Japan's point of view. And this is one of the reasons why the value of the yen is so low, because when you look at the fundamentals as to what's happening in Japan, it tells you that there are serious problems. And one other thing that we haven't discussed yet is what's going on with the national debt. Japan has a huge amount of national debt. Now, you might be sitting there thinking they can't have as much debt as the USA, and they don't in real terms, but in relative terms they do. The debt to GDP ratio in Japan is over 250%, which is more than double the ratio for the USA. So in relative terms, Japan has taken on a huge amount of debt, and that's further adding to their problems. So what's the summary and conclusion today? Well, I wanted to post this video because I think what's happening right now in Japan is absolutely fascinating. When we talk about exchange rate manipulation, which is basically what Japan have been undertaking over the course of the last few days, we're normally talking about countries such as Cuba and Argentina that are in complete economic disarray, where the government is setting an official exchange rate that everybody else ignores, a black market starts forming, and people start trading in other currencies, and you get a high level of what's called dollarization, where everybody abandons the home currency and moves on to doing something else. But we're talking about Japan here. This is the fourth largest economy in the world. It used to be the second largest. This is one of the most developed economies that we have. So the exchange rate should tell us exactly what's happening in that economy. It should be set by the market and give us a really good indication as to whether or not Japan's doing well or it's in difficulty. And what the yen exchange rate is telling us is that Japan is in severe difficulty right now. The fact that the value of the yen has been falling for the last 2 years shows that this has been a prolonged problem. But when you look at what's been happening over the last month, that problem has been accelerating. And over the last week, the Bank of Japan has been forced to step in and make purchases on 2 separate occasions to support the value of the yen. Now, as we've seen from the data, that hasn't actually worked. when you step in and start buying large quantities of your currency, it only has a really short-term impact. And the Bank of Japan spent $35 billion at the start of this week trying to improve the exchange rate, and that lasted for a matter of hours. As soon as they stopped making those purchases, it went back to the market rate and drifted down again. And then on the 2nd of May, the Bank of Japan did the same again. And all they're doing is wasting a lot of value here, trying to protect the value of their currency. Now, this is more of a vanity thing. They've got it in their minds that they don't want the exchange rate to be more than 155 to $1 US. So they're trying to keep it at that level. But it's the fundamentals of what's happening in Japan that's causing the rate to move to that level. And as we've seen from today's video, the fundamentals are not good. Japan has an aging population. It's got declining population. It's also got GDP, which is slowing considerably. It's tried to increase its inflation by injecting a huge amount of capital into the economy. But quantitative easing has its own problems. Usually, it drives up inflation. But in Japan, it's only driven up inflation to around 4% at the maximum. So once you take that quantitative easing out of the economy, it's likely that Japan will go back to seeing deflation. And if the economy does return to a situation of deflation, it's going to be in severe difficulty because it doesn't have many other options left to it. Interest rates are already down at rock bottom levels, and the quantitative easing program is maxed out. So Japan is facing severe problems here. And as it's a net importer, as the value of the yen falls in the international markets, it makes the cost of all of its imports much more expensive. And that's going to apply further pressure onto the economy. Now, you might be sitting there thinking, well, surely if the cost of the imports goes up, isn't that going to increase inflation? So wouldn't that be good for Japan? But it wouldn't, because all it will do is increase all the costs of the imports, which it doesn't have any control over, and make it more difficult for all of the companies in Japan to actually make a profit, because it'd be increasing their costs. And it's likely to result in the consumers in Japan, who are an aging group, to be more cautious, to save more, to spend less, and therefore reduce demand and possibly increase deflation further. So we have this vicious circle where the price of imports is going up while deflation accelerates. And that could be really catastrophic from Japan's point of view. So the overall summary of today's video is that over the last 2 years, we've seen a significant fall in the value of the yen. That fall in value is now accelerating. The Bank of Japan has decided to step into the market to try to solve that problem, but basically it's only papering over the cracks. It isn't fixing the fundamental problems, it's just trying to affect the price. That won't have a long-term impact. It won't solve any of the issues for Japan. And the outlook for Japan for the next 3 to 6 months is negative, and it's likely that we'll see continued falls in the value of the yen as most of the market no longer wants to buy it. So hopefully you've enjoyed today's video, you found it useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. Thank you for watching this video all the way through to the end, and here's something to put a smile on your face.